The Dow crossed 53,000 for the first time in history today. And on that exact same day, Microsoft cut 4,800 jobs. Both headlines ran at the same time. Most people scrolled past one of them. Here's the uncomfortable part. Those two events are not a contradiction. They are the same story. And once you see how they connect, you cannot unsee it. Microsoft did not just trim some overhead this week, it gutted its Xbox gaming division. It announced plans to spin off 4 separate gaming studios. Thousands of people lost their jobs in a single announcement, and Wall Street barely flinched. In fact, markets climbed. The Nasdaq posted gains, chip stocks surged. The Dow briefly touched 53,000 for the very first time. So how does a company cut 4,800 jobs and the market goes up? That is the question most financial coverage skips entirely. The answer reveals something important about how this system actually works. When a large company announces layoffs, there are 2 ways to read it. The first way is the human way. Families disrupted, mortgages stressed, careers derailed. The second way is the Wall Street way. Lower headcount means lower payroll costs. Lower costs mean wider profit margins. Wider margins mean higher earnings per share. Higher earnings per share means the stock gets a boost. The math is cold, but it is real. And the frustrating truth is that both readings are accurate at the same time. Now here is where this gets more interesting. Microsoft is not struggling. This is not a company in crisis cutting costs to survive. Microsoft is one of the most profitable companies on the planet. It is deep inside the AI build-out. It is a core holding in almost every major index fund. If you own the S&P 500, you own Microsoft. So when Microsoft cuts jobs and the stock rises, you technically benefit. Xbox cuts are specifically revealing. Gaming is a sector where Microsoft has spent years acquiring studios. The Activision Blizzard deal alone cost nearly $69 billion. Now it is spinning off studios, downsizing the unit. That is not a sign of a booming division. That is a company deciding that gaming as a standalone business is not worth the cost structure it built. And spinning off assets is a way of saying, this part of us is not generating enough return. Wall Street loves that kind of discipline. Investors love a company that cuts underperformers, even when underperformer means thousands of people. Here's what this week's news actually confirms about the broader market. We are in an environment where efficiency is being rewarded aggressively. Every major tech company is running the same calculation right now. AI can replace certain functions, headcount can be reduced, margins can expand, and the stock market will applaud. That dynamic is not new, but it is accelerating in 2026 in a way that is directly shaping these record index levels. The Dow at 53,000 is partially a story about AI investment. It is partially a story about chip stocks surging, and it is partially a story about companies running leaner by cutting people. That combination is what is pushing these numbers higher. If you are finding this useful, consider subscribing for more practical financial insights. Now here is what most investors get completely wrong when they see layoff news. They treat it as separate from their portfolio. They see the human story and the investing story as 2 different things. But they are operating in the same space, and ignoring the connection leaves you with blind spots. The practical question for everyday investors is this: if large tech companies are rewarded for cutting costs aggressively, where does that end? At what point does cost cutting stop growing earnings and start shrinking the revenue base? That is the tension nobody is pricing in right now. You can cut your way to higher margins for a while, but if you cut too deep, you lose the talent building the products. And in a sector where product quality determines market share, that matters enormously. Microsoft has bet that AI tools can absorb some of what those 4,800 people were doing. That bet may be correct. Or it may create gaps that only show up in next year's product cycles. The market is assuming the former. History suggests the latter happens more often than executives admit at the time. Here's a practical way to think about this. If you own index funds, you are a partial owner of Microsoft right now. When it cuts costs and margins improve, your fund benefits. That is the mechanical reality of index investing, but understanding why those numbers improved helps you anticipate what comes next. If the entire S&P 500 is running the same playbook simultaneously, the overall earnings picture looks strong in the short term. But the consumer spending picture, the employment picture, and the wage growth picture all weaken. And those are the same indicators that eventually feed back into revenue. This is the loop that long-term investors need to track. Not just whether the market went up today, but whether the conditions sustaining that growth are actually durable. The 10-year Treasury yield sitting at 4.49% right now tells part of that story. Bond investors are not fully convinced the economy is as strong as the Dow's headline number suggests. Higher yields mean the bond market is pricing in some combination of persistent inflation or ongoing government borrowing pressure. Neither of those is a signal of unambiguous economic health. So you have a stock market celebrating milestones. You have tech companies cutting thousands of jobs in the same breath. You have bond yields rising in the background. And you have AI investment being used to justify both the cuts and the stock price gains simultaneously. That is the full picture, not just the headline number. The people who build lasting financial resilience are the ones who read both lines of the story, not just the one that makes the market feel invincible. What you do with that full picture is entirely your call. But having it puts you several steps ahead of most casual investors scrolling past the Dow milestone this week. Chapters: 0 o'clock hook. The day 2 headlines collided. 0:45. What actually happened at Microsoft. This week. 2 o'clock. Why Wall Street rewarded the cuts. 4 o'clock. What this pattern reveals about stock prices. 6 o'clock. What everyday investors should do with this. 8 o'clock. Final thoughts.